In your first mortgage payment, only $312 goes toward owning your home. The other $1,629, that's just rent you're paying to your bank for the privilege of being in debt. And here's the part nobody tells you when you're sitting across the table from the loan officer, trying to remember if you need to initial or sign on that page. After 7 full years of payments, 84 checks, over $163,000 out of your pocket, you've paid off just over 10% of your loan. 10%. You could have paid nothing for the first 6 years, handed over a lump sum in year 7, and you'd be in roughly the same place. That's not a bug. That's not a quirk. That's a feature, one that was baked into the math of your mortgage before you signed your name 100 times on closing day. This is the amortization schedule, and once you understand how it works, you'll never look at your monthly payment the same way again.
Let's start with what most people believe. They believe that every mortgage payment is building equity, that every month they own a little more of their home, that they're slowly, steadily paying off their debt. All of that is technically true and almost entirely misleading.
Here's the reality. Your mortgage payment is fixed, the same number every single month for 30 years. But what's inside that payment changes dramatically depending on where you are in the schedule.
In the early years, almost everything goes to interest. In the final years, almost everything goes to principal. The math is simple, and it's brutal. The bank charges you interest every month on your remaining balance. When the balance is high, which it is in the beginning, the interest charge is enormous. Your fixed payment covers that interest first. Whatever's left over chips away at the principal. The first month on a $320,000 mortgage at today's rates, that leftover is $312. The bank gets $1,629. You get $312. The next month, the balance is very slightly lower, so the interest charge is very slightly lower, which means a very slightly larger slice goes to principal. It accelerates, but so slowly that for the first 19 years and 9 months, more of every single payment is going to your lender than to your own equity. You don't hit the point where you're paying yourself more than you're paying the bank until month 225. Month 225. That's 18 and a half years in. At that point, you have 11 and a half years left on the loan. You've spent 62% of your mortgage's life in what I'll call the bank's half. That's not an accident of arithmetic. That's the structure working exactly as designed.
Now let's follow the money, because this structure didn't emerge from nowhere.
Before 1933, mortgages were completely different. You'd borrow money for 3 to 5 years, pay only interest, then hand over the entire principal in a balloon payment at the end, which you do by refinancing into another balloon loan, kicking the can indefinitely.
You needed 40 to 50% down. Only 40% of Americans owned homes. Then the Great Depression hit. Banks failed, credit vanished. Balloon payments came due, and borrowers couldn't refinance. Foreclosures hit 1,000 per day in 1933. Half of all mortgages went into default.
The government stepped in. The Homeowners Loan Corporation, HOLC, was created in June 1933. They refinanced over 1 million distressed mortgages and introduced something entirely new, the fully amortizing loan. Same payment every month, covering both interest and principal, until the balance hits zero. It worked. Home ownership climbed. The FHA standardized it, pushed terms from 15 to 20 to 25 years to keep payments affordable. Congress didn't authorize a 30-year term until 1948 for new construction and 1954 for existing homes. Fannie Mae, created in 1938, built the secondary market that made the whole thing possible. Banks would originate loans and sell them to Fannie, getting their capital back immediately to make more loans. The 30-year fixed-rate mortgage wasn't designed to be profitable for banks in the traditional sense. It was designed to make banks willing to lend at all.
The amortization schedule isn't a conspiracy. It's a mathematical consequence of charging interest on a declining balance with equal payments. But the system built around it, that part absolutely has incentives. Here's who benefits. The bank originates your loan, collects an origination fee, around $2,400, then sells the loan into the secondary market, getting their capital back within weeks. But they keep something called the mortgage servicing right that earns them around 0.25% per year on your outstanding balance, which is highest in the early years.
The investors who buy mortgage-backed securities receive all that front-loaded interest income passed through directly. High balance, high interest, high income, in exactly the years when the borrower is least likely to pay it off.
Fannie Mae and Freddie Mac guarantee the whole stack. They charge 62 to 65 basis points per year on every dollar they insure. As of the most recent figures, they're sitting on responsibility for about $6.5 trillion in residential mortgage debt. The system works. It's liquid. It's stable. It got 65% of Americans into homes. But here's the part worth holding on to. The average mortgage lasts about 7 years before the borrower either sells or refinances. 7 years, right in the sweet spot of maximum interest extraction.
Which brings us to the refinancing trap. Imagine you've been in your home for 7 years. You've made 84 payments. You've paid $163,000. And rates drop. Your lender calls. Your neighbor mentions it. Your inbox fills with ads. The message is clear. Refinance now. Lower your rate. Lower your payment.
It sounds like winning. Here's what actually happens. If you refinance your remaining $287,000 balance into a new 30-year mortgage, even at a rate a full percentage point lower, you will pay $19,637 more in total interest over the combined life of both loans. You heard that right. A full point lower, still more expensive. You'd need rates to drop by 1.42 percentage points from today's levels just to break even on total interest. Not to come out ahead, to break even. Why? Because you're resetting the clock. You're going back to month 1. Your new loan front-loads the interest all over again. Instead of finishing in 23 years, you're now on a 37-year timeline. Your monthly payment is lower. The feeling is real. The math is not. Most financial advisors will tell you to refinance when rates drop by 0.75 points. And they're not wrong, if you're measuring by monthly payment savings and closing cost break-even. Most people recoup closing costs in 2 to 3 years.
But that's a completely different question from total cost. The industry measures the math it wants you to see. Monthly payment, break-even months. Not how much interest will you pay over the life of this loan versus the one you have now. Every refinance also generates new origination fees, new closing costs, 2 to 6% of the loan. And it starts the amortization clock over, which means the investors collecting your mortgage payments get another round of front-loaded income. This is not a coincidence. It is a business model. The 2020 and 2021 refinancing boom generated 14 million new mortgages in about 18 months, nearly $2.8 trillion in refi originations in 2021 alone. Every one of those borrowers reset their amortization clock. Every one paid new fees. Every one started back at month 1.
So what can you actually do about it? First, understand what you're buying when you buy a home. You're not buying a house. You're buying a house and you're renting money from a bank to do it. Those are 2 separate transactions happening at once. The bank's transaction is the mortgage. Over 30 years at current rates, on a $320,000 loan, you'll pay $378,850 in interest, more than the loan itself. Your $400,000 house costs $779,000 by the time you're done.
Second, if you refinance, match the term. Don't refinance at year 7 into a new 30-year loan. Refinance into a 23-year loan, matching your remaining schedule. Your payment won't drop as much, but your total cost will.
Third, and this is the one most people ignore, extra principal payments are the highest return financial decision available to the average homeowner, and almost nobody makes them. Adding $100 a month to your mortgage payment, less than most people spend on streaming services, saves $55,640 in interest and cuts nearly 4 years off the loan.
Every dollar of extra principal reduces future interest in a compounding way, because lower balance means lower interest charge next month, which means slightly more of that month's payment goes to principal, which lowers the balance further. It's the same engine that front-loaded interest against you, working for you. Or try the bi-weekly payment strategy. Pay half your monthly payment every 2 weeks instead of the full amount once a month. That gives you 26 half payments per year, which equals 13 full payments instead of 12. Completely automatic, no willpower required. Saves around $81,600 and cuts 5.5 years off the loan.
Here's the thing about the amortization schedule. It was designed to solve a genuine problem. Before it existed, people couldn't afford to own homes. Lenders wouldn't lend. The system was broken in a different direction. The 30-year fixed-rate mortgage is, in many ways, a remarkable invention. You get a locked rate for 3 decades, no prepayment penalties, the flexibility to sell whenever you want. Those are real advantages. They're real protections. But they come with a cost that's almost never disclosed in plain English.
You'll spend the first 2/3 of your mortgage's life paying mostly interest. If you move or refinance every 7 years, which most people do, you'll spend your entire homeowning life in that zone. You'll pay $4 in interest for every $1 of equity you build through payments, and every time you restart, someone else collects an origination fee, a servicing fee, a guarantee fee.
The house appreciates. You get that. The market gives it to you whether you have a mortgage or not. But the mortgage itself? The mortgage is a subscription you signed up for at 30 years old that was designed, not maliciously, but structurally, to extract as much interest as possible before you figure out how to cancel it.
The good news is you can cancel it early. Most people just don't know they're subscribed.